You are sitting at your kitchen table on a Tuesday night, staring at a confirmation screen. You just transferred $2,000 to your landlord. As the page loads, you feel that familiar, heavy sink in your chest. Every personal finance article and piece of advice from society tells you the exact same thing. Renting is throwing your money away. You are paying someone else's mortgage. To make yourself feel better, you open Zillow, filter for the lowest prices in your city, and eventually find that mythical starter home your parents keep talking about for $400,000. But then you look closely at the photos. The kitchen has peeling laminate countertops from 2003, and the carpet is just contractor beige. The listing agent describes it as a cozy canvas waiting for your personal touch, which is really just real estate code for an overpriced money pit. The idea that a mortgage is an investment while rent is a waste ignores a basic financial reality. When you pay $2,000 in rent, you are buying a ceiling on your financial liability. That is the absolute maximum you will pay for housing this month. A mortgage, on the other hand, is the absolute minimum you will pay. Today, we are going to break down the cruel, undeniable mathematics that the real estate industry hides. We're going to run the invisible numbers your mortgage broker hopes you never sit down to calculate. Right now, in 2026, the modern starter home has shifted from a wealth-building launchpad into a carefully disguised financial trap. This chart shows the true cost of buying that $400,000 house. Let's say you scrape together a 10% down payment, $40,000. At current interest rates, your basic monthly payment for principal and interest on a $360,000 loan is roughly $2,150. But the bank isn't done with you. We have to add property taxes, which average about $450 a month. Then comes homeowners insurance. Between 2020 and 2024, insurance premiums spiked 48% nationally due to climate risks, adding conservatively another $300 to your monthly bill. Because you didn't have $80,000 sitting around to put 20% down, the bank forces you to pay private mortgage insurance, or PMI. This is an added fee of roughly $275 a month that protects the bank in case you default. It is a penalty fee for not being wealthy that offers the buyer zero protection. Finally, the golden rule of homeownership is budgeting 1% of the home's value every single year for maintenance. That is another $333 a month. Add it all up, and your $2,150 mortgage just became $3,508 a month. To comfortably afford $3,500 under the classic 28% rule of personal finance, you need a household income of roughly $150,000. But the bank doesn't use that rule. They will approve your loan as long as your total debt-to-income ratio stays under 43%. They will approve someone making $98,000 for this loan, even if it leaves them with no margin for error. Technically affordable and sustainably comfortable are two completely different concepts, and the banking system profits by blurring the line between them to extract maximum interest. Let's see what living inside this math actually feels like. Meet David and Elena. They make a combined $98,000 a year and bought the starter home. After taxes and insurance, they take home about $5,800 a month. Their new housing costs instantly consume $3,500 of that. This chart shows what happens to their remaining $2,300. They have 2 car payments totaling $700. Gas and car insurance take $300. Groceries run $600. Student loans take $400. Utilities and phones cost $300. Before they save a single dollar or buy a piece of clothing, they have $0 left. Then month 6 arrives. It is 95 degrees outside, and the HVAC system in their cozy starter home completely dies. The repair quote is $6,000. Because they are spending 60% of their take-home pay on a house, they have no savings. The entire $6,000 goes on a credit card at 24% interest. When Elena's car needs new brakes 2 months later, that $800 goes on the credit card too. Every unexpected expense becomes a crisis. You are lying awake at 3 in the morning doing mental math over a weird noise the refrigerator is making. You cannot leave a toxic job because your massive fixed costs demand every single dollar of your current salary. This debt functions as a 30-year employment contract with a bank, where your energy is spent maintaining a building you cannot afford to leave. This chart shows the alternative. Your friend Marcus makes the exact same $98,000. But Marcus looks at the massive cost of owning, decides to keep his $2,000 rent, and puts his $40,000 down payment into a low-cost S&P 500 index fund. The S&P 500 is a stock market index tracking the performance of 500 of the largest companies listed on U.S. exchanges. Every month, he automatically invests the $1,500 difference between his rent and the cost of a mortgage. Over the long term, spanning recessions and pandemics, the S&P 500 has returned an average of roughly 10% annually. Real estate historically appreciates at about 3.5% to 5.5%. Fast forward 20 years. David and Elena plunged every spare dollar into maintaining their home. It is now worth $800,000, but they don't actually have that money. They have equity trapped inside a foundation. To use it for retirement or medical care, they have to sell and pay massive transaction fees, or borrow against it and go back into debt. Marcus never fixed a leaky roof or paid a property tax bill. After 20 years of compounding, his portfolio has grown to over $1.4 million. He is a liquid millionaire. He can withdraw 4%, $56,000 a year, and live off the passive income without ever touching the principal. The house didn't make David and Elena wealthy, it made them busy. Marcus became wealthy because he understood the goal of wealth is not owning physical property, but acquiring options and the freedom to dictate your time. Right now, in 2026, renting is mathematically cheaper than buying in all 50 of the largest metropolitan areas in the United States. Nationally, buying costs about 38% more than renting. In markets like San Francisco or Seattle, buying costs nearly 200% more. The reason your parents look at you with disappointment when you renew your lease is because they are giving you advice based on an economy that no longer exists. When baby boomers bought starter homes, the median price was roughly 3 times the median household income. Today, it is 5 to 10 times that income. Financial rules from 1985 are obsolete in 2026. The real estate industry generates billions of dollars in interest for banks by pressuring consumers to take on the absolute maximum amount of debt the law allows. They associate renting with failure to ensure you sign up for that debt. You can reject the pressure to buy. True wealth is built by investing the gap. When you sit in a manager's office and they hand you a piece of paper with a new salary of exactly $100,000, you are supposed to feel your financial anxiety disappear. Society tells us that 6 figures is the ultimate finish line. You call your parents, you take your partner out for a $200 celebratory dinner, you finally allow yourself to exhale, believing you have crossed the threshold into permanent stability. Exactly 8 months later, it is 8 p.m. on a Tuesday. You are sitting in the parking lot of a grocery store, doing frantic mental math to figure out if spending $45 on dinner will trigger an overdraft fee before your paycheck hits on Friday. This bar chart illustrates the stark reality of the 6-figure bracket. Nearly 48% of people earning over $100,000 a year report living paycheck to paycheck, walking a financial tightrope with absolutely no safety net below them. The systemic illusion of a 6-figure salary often makes high earners mathematically poor by convincing them they have already won the game. When you get that $100,000 offer, your brain instantly divides the number by 12. You start planning a lifestyle around $8,333 a month. This diagram shows what actually happens to that money. It runs a gauntlet. Federal taxes take a slice, state taxes take theirs. Then comes FICA, the federal payroll taxes that fund Social Security and Medicare. After health insurance and a basic retirement match, your true take-home pay shrinks to roughly $5,800 a month. Because your brain anchored on the pre-tax fantasy, you lock in expensive housing and car payments based on phantom money that will never physically reach your checking account. The moment you hit 6 figures, you enter a demographic called Henry. Henry stands for High Earner Not Rich Yet, a classification for professionals with large incomes but little to no accumulated wealth. Entering this bracket puts a massive consumer target on your back. The consumer economy extracts that salary through a series of completely justifiable decisions called lifestyle creep. You got a raise, so you move out of your cramped apartment into a luxury complex with a courtyard, instantly increasing your rent by $600 a month. The real danger of a high salary is the false psychological baseline it creates. You stop looking at prices at restaurants because you feel like a six-figure professional shouldn't have to anymore. Upgrading your apartment triggers the Deutero effect. The Deutero effect is a psychological glitch where acquiring one new premium possession makes all your older belongings look completely inadequate by comparison. Your 2016 Honda Civic with a peeling steering wheel no longer matches your luxury apartment. You walk into a dealership and agree to the average American new car payment of $748 a month. This split-screen graph shows the hidden math of that decision. On the left, you buy a machine that loses 20% of its value the second it leaves the lot. On the right, if you invested that same $750 a month into a standard S&P 500 index fund, a mutual fund tracking the largest 500 U.S. companies, it would compound into roughly $1.6 million over 30 years. Then comes the house. Banks enthusiastically approve massive mortgages using a debt-to-income ratio. Debt-to-income is a metric lenders use that compares your total monthly debt payments to your gross pre-tax monthly income. They completely ignore your after-tax reality, locking you into a mortgage that consumes half of your actual take-home pay. Finally, the modern economy delivers the exhaustion tax. You are working 50 stressful hours a week. You are too tired to cook, so you spend $45 on DoorDash 3 times a week. You bleed money on premium gym memberships you are too tired to use, and digital subscriptions that average $219 a month. This ecosystem is precision engineered to extract every single dollar of your income. If you lose your job, you don't lose a luxury lifestyle, you lose your survival. Escaping this trap requires the art of stealth wealth. You have to learn to completely separate your personal identity from your consumer consumption. Performing wealth for an audience that isn't even paying attention is the exact mechanism keeping you functionally broke. This flowchart illustrates the anti-lifestyle creep protocol. The second your income goes up, your lifestyle does not get to find out about it. You immediately automate 75% of any new raise directly into your investment accounts before it ever reaches your checking account. You also implement the 72-hour firewall. The 72-hour firewall is a rigid rule where you force yourself to wait 3 full days before making any non-essential purchase, giving your brain's dopamine-driven wanting system time to cool off. If you are already caught in the cycle, you have to do the painful work of structural reduction. Swallow your pride, sell the expensive car, take the hit on negative equity, and buy a reliable 10-year-old vehicle with cash. Cancel every subscription you do not use weekly. Statistically, 86% of luxury car drivers are not millionaires. The person driving a paid-off, decade-old commuter car has kept their wealth, rather than trading it away to a dealership. The goal of building wealth is not the ability to buy expensive things. True wealth is options. It is the power to absorb a broken transmission without spiraling into high-interest debt, and the absolute freedom to look at a toxic boss and politely walk away.